Hello there. Thank you so much for joining us today. I'm Marche Butler, the webinar director here at Advice Chaser. We want to welcome you. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, folks, we're thrilled to bring you this educational presentation. I have a couple of instructions for you. Attendees are muted, but we do encourage you to go ahead and ask questions using the chat box. I'm going to go ahead and enable that right now. All right, the presenter will answer those queries during a question and answer portion, both in the presentation today and after the presentation today. So please don't hesitate to ask your questions and make comments in the chat. If we can't get to your question during this event, go ahead and leave your contact information as well, and we'll make sure someone reaches out to you after today's event to get that addressed. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our presenter today. Rob Bacharach founded RB Wealth Partners in 2021 after serving as co-founder and financial planner at Carter Bacharach Financial Group. He holds both a certified financial planner and chartered retirement planning counselor professional designations. Rob has a passion for solving complex financial matters for those who earned their current positions every step of the way and creating long-term personal relationships with his clients. As a member of the Charlotte chapter of the nationally recognized Financial Planning Association, he obtained a Bachelor of Arts degree in both business and communications from Queen's University in Charlotte. And Rob, we're excited to have you here. We've already got a question in the chat. I'll let you know we will be addressing those during some specific portions of the event. But thank you. Keep those questions coming. Rob, I'll turn the time over to you.
Thank you very much, Ed, and thank you for everybody for joining us here today. Very much looking forward to it. Excited to see that we've already got some questions coming in. That is what we are here for. I am going to do my best to get through the information relatively quickly so that we can leave plenty of time for questions in the middle and at the end. So please don't hesitate to send your questions into Marchette, and if we don't answer them during the presentation, I will make sure that we get to them at the end. And so without further ado, again, thank you everybody for joining us here today. Let's dive in. So I know everyone is here to figure out, what do I do with my cash? And it's interesting because when we first started planning this presentation, we had a slightly different approach to some of the things that we were going to go over than what I have now with regards to everything that has happened in the news and the banking industry over the course of the last couple of weeks. And so I did go ahead and update a few of our slides for you all today to touch on a little bit more of some of the current event topics that we are being asked about today. I'm not an insider with the banks or anything like that, but I serve a lot of clients and we have lots of questions that are simply related to what do I do with my cash inside of the bank. But the questions have shifted a little bit. So where we started off here originally was a lot of folks recently that we've spoken with over the course of the last few years have had some of their best years ever, whether it was from sales or they sold a piece of real estate that they cashed out on, or stepping out of funds from the stock market, whatever it might have been, they've done really well in a variety of different capacities. We have a chunk of money in cash just sitting in the bank, and we're just not sure what to do with it. And part of the problem is there's just so many options out there. I don't know, do I leave it in the bank? Real estate seems too expensive right now. Home improvement even seems expensive right now. I'm not sure what to do with bonds. There's all these different money market accounts. And so people are kind of frozen in this, I'm not sure what to do sort of state right now. And so these are topics that we're talking about with folks a lot. And so, but before we go into all of these different options for what to do with your cash, from a financial planning standpoint, and something that I talk with folks about on a regular basis, is making sure that we have some very foundational boxes checked inside of our financial plan before we go to the next level of whether it's stock market or real estate or small business investing, whatever it might be. And so I'm not going to spend too much time here, but I do just want to touch on these just to make it very clear that these are things that you really, if you're on here because you have extra cash, make sure these boxes are checked. I'm sure for most folks they are, but let's make sure. And so fundamentals first. So first and foremost, if you're here because we have extra cash, make sure that you've got any and all high interest debt paid off. So in my opinion, this is anything over about 10%, credit card debt, personal loans, things like that. Make sure that we get those paid off. Make sure that you have an appropriate emergency fund or increase your emergency fund a little bit. For most folks, general rule of thumb is 3 to 6 months worth of your monthly expenses in an emergency fund. And I recommend using a truly separate account for this money. So if you have to even put it at a separate bank for out of sight, out of mind, go ahead and do that. But this is money that truly is off to the side, not to be used for anything except for the unexpected. The HVAC system goes out, unexpected medical bills, or we get into a car accident, things like that. Okay. And so 3 to 6 months, typically the range of that is based on how stable your income is. If you work on commissions and your income fluctuates, maybe go a little bit further to the end of the spectrum. But in general, right now, we have a lot of certainty. So I recommend everybody just increase it a little bit more than where you might have it today. Same thing for upcoming large expenses. Look out the next 18 to 24 months or so. Anything that you already know that you're going to have to spend your cash on, whether it is tuition for a child's college, if it is home improvement coming up, whatever it might be, take a look, go out 12 to 18 months and make sure that you just put that money aside as well. Other things that we are talking about, folks, with that have crept up is property and casualty and life insurance. So update your policies, but specifically with property and casualty, over the last 2 years, we've had this boom in the value of real estate. And so it is really important that you go and make sure your homeowner's insurance is covering the current value of your home, not the 2 years ago value of your home. Depending on how big your house is, this might cost you a little bit more money. So I wouldn't say this is going to take a big chunk of your cash up, but it's a good thing. Just go check the box. Make sure that your homeowners is for the current value of your home. And in that same vein, we have a lot of folks that have, with home values up, property taxes are now updating and going up. And when property taxes go up, sometimes your mortgage bank will say, hey, you need to either put a chunk more into escrow or your mortgage monthly payment is going to go up. So these are just some little things that sometimes creep up on us, stuff we've been getting questions about a lot recently. And so I strongly recommend go check the boxes on these little items here. So with all that being said, let's dive into a little bit more of what has been in the news over the course of the last couple of weeks. Something we are getting questions about regularly is FDIC insurance, right? My money's at the bank, but is it safe? Can I leave it there? Do I need to take it out? What's going on with, SBNY and SVB and Credit Suisse and all this stuff? Is my cash even safe there? So, and then helping folks understand, well, here's what's covered. Here's what the federal government has stepped in to say that they're, going to cover what they're responsible for at these banks. And so FDIC insurance, Federal Deposit Insurance Corporation is for banks. So traditional banks, think Bank of America, Wells Fargo, your local bank down the street, okay? SIPC is Securities Investor Protection Corporation. This is for brokerage firms. Think Fidelity, think Merrill Lynch, okay? So FDIC insurance does not apply to brokerage firms, and brokerage firms, SIPC insurance does not apply to traditional banks, okay? So they are two different things. But when we're talking about, we've got a whole bunch of cash that is sitting somewhere, whether it's at a bank or maybe it is in our brokerage account, a place that we could buy securities with it. But right now it's just in cash. It's important to know how much coverage we really have if something were to go wrong. And so I've got this isn't anything fancy. I just got this put together for everybody here in the last few days. And so we just have a really basic chart here. What is covered, what's not, how much. So FDIC insurance, this is for money in your bank account. So in your checking account, in your savings account, CD, securities of deposit, okay? SIPC coverage is for assets that are held in a brokerage account. So maybe cash that you have in an account where you're able to go buy securities like stocks, bonds, and mutual funds, right? So that's how you can kind of think about SIPC versus FDIC. If you can't go buy stocks and bonds and things like that, then it's probably in a bank account. If you can, it's probably in a brokerage account. SIPC coverage will cover things like the value of money market mutual funds, stock bonds, treasury securities, things like that. What is really important, and I can't stress this enough, SIPC coverage does not protect the fluctuation in value of your investments, okay? So if you go and buy a mutual fund and that mutual fund goes down 50%, that is not what SIPC coverage is for. SIPC coverage is for if the institution holding your money, so think Fidelity or Merrill Lynch, holding your money, if they run into trouble and an investor would not be able to access the value of their investments, that is what SIPC coverage is for. Okay, so it does not protect you from a stock going way down or a fund going way down at all. All right, it is for protection for the institution and the cash and the value of the funds that are inside of your account. Okay. For the FDIC, something that I like to point out here is that it's not going to cover safety deposit boxes, all right? So if you have a whole bunch of cash that is in a safety deposit box at a bank, the bank doesn't know that's not really money that the bank can use to go lend and borrow, unlike the money in our checking and savings account. So just keep that in mind. Safety deposit boxes are not going to be covered. Okay. How much is covered? And this is where things get a little bit complicated, and this is where we've been getting a lot of questions. So you get up to $250,000 per depositor, per FDIC insured bank, per ownership category. I'm going to go over what ownership categories are in just a minute. At SIPC covered institutions, you get up to a total of $500,000, and of that 500, up to 250,000 could be of cash that is in the brokerage account to buy securities. Okay, the per ownership category also applies to the SIPC rules as well. Okay, and again, before I change here, this is for if the bank runs into trouble or if the brokerage firm runs into trouble, not for change in value of investments. Okay, what are ownership categories? In here, in the second column from the left, are examples of ownership categories. Okay, so if me, Rob, has a single checking account at a bank, that's an individual account or a single account, that's one specific ownership category. If my spouse has a single individual checking account, that's an individual ownership category. If I have a joint checking account with my spouse, then that is a different ownership category, different than the max on the individual account ownership. So what this is telling us here in this specific example, if this husband and wife had all of these different types of accounts, they each had a single account, they each had an IRA, they have a joint account together, and they each have trusts. Each of these accounts has maximum for the amount of cash that would be covered by the federal government if that bank were to go into trouble. And so the total amount of coverage that would be available at this one single bank would be $2 million. Okay, so what to pay attention to here is that spreading your money out into different ownership categories, different types of accounts, that can help increase the amount of cash you can hold at one institution that would be covered. To give you another example here, married couple Lisa and John. Lisa and John bank at ABC Bank. Lisa has an individual savings account with $250K. John has an individual savings account with $250K. Lisa and John have a joint checking account with $500,000 in it. Their total FDIC coverage at this one bank would be $1 million. All right. If John or Lisa had over $250,000 in one of their individual savings accounts, that amount would not be covered because they are over the limit of coverage of what's available for a single account type, that type of account ownership. So if you are somebody who has, let's say, $300,000 at one bank in a single account, and you don't have any options for creating a different type of account at that bank, it might not be a bad idea to go utilize another bank, right? If you're at Bank of America, go open an account at Wells Fargo or wherever you want. That way, you can max out at $250K at one bank and then take the excess and go move it into another bank, because your coverage is at one bank at a time. So you could have $2 million of coverage at one bank in this example, and you could have another $2 million in the same example at a totally different bank. Okay. And so this is just to give some clarity to folks about what FDIC coverage is, how it works, and how to know if you've got too much cash in one place, and what the federal government is saying, especially recently, of what they're willing to step in and cover and what they would not cover. These same type of ownership rules also apply to the SIPC coverage as well. So same idea. If you're at a brokerage firm like a Fidelity, and you've got a individual investment account, a joint investment account, an IRA, an investment account held in trust, those are all your separate ownership categories that apply the same as the examples we've looked at here. Okay, so just for everyone's quick reference here, these are two really easy websites that you can go to. The SIPC.org and the FDIC.gov are places you can go so that you can get details about. You can read through these examples. They make this information very easy and legible on their website. So I recommend going to check those out if you have additional questions. All right, now let's get back to what we came on here today to talk about, which was, okay, now I've got all this cash and I'm not sure what to do with it. And now recently I'm confused about all this FDIC and bank failure stuff and things like that. But let's get back to, I have the cash. I'm not sure what to do with it. There are too many options. And so before we get into some of the more advanced investment topics, let's just talk about, I need or want to use my money in less than 2 years. What options might I consider? And for purposes of today's discussion, what are the differences between these options? We've been getting a lot of questions about, well, why don't I just leave my money inside of a high interest checking account versus putting it into a money market mutual fund? Right? What's the difference? Why would I do one versus the other? Is it worth my time to go open another account at another institution to do that? So what I want to touch on here in this slide is high interest checking accounts, or what are known as money market savings accounts. So it's a money market that is held at a bank. okay, versus a money market mutual fund versus a CD. At banks, traditional banks, right? So we'll just use Bank of America as the example, or Wells Fargo as the example. We have checking accounts, we have savings accounts, and then we have what they're calling money market savings accounts or high interest savings accounts, okay? These are held at banks. These are not investments. These are not mutual funds, okay? So this is not a security. So these are under FDIC coverage. They will tend to have lower rates than a fund that you might purchase inside of a brokerage account. Not always, but typically. You have bank fees to pay attention to, minimum deposits to pay attention to. All right, so sometimes to get the best rates, they'll say, well, you have to start with $50,000 inside of this account. Or you have to have 25,000, or if you go below a minimum, then we're going to start charging you a monthly banking fee and things like that. The other thing to look out for on checking, savings, money market savings accounts is a lot of the times what I'm seeing recently advertisements for is just these introductory periods. So you'll see, 4.5%, and then the fine print says for the first 3 months. Okay. And so that's important to pay attention to before you go and take the time and energy to go open a brand new account at a new bank just because you saw an ad online, offering a 4.5% interest rate. Read some of the fine print. How long does that even, how long does that interest rate even stick around for? Okay. Money market mutual funds, think your brokerage account, think SIPC coverage. Okay. So money market mutual funds, while they are considered a cash-based investment, it is a security. Okay. So it's something that's going to be held at a brokerage firm. It's going to be SIPC covered. They will tend to have higher rates than your high interest savings account. Not all, but the general norm. They're going to have fund fees versus bank fees. So if you've heard the term net expense ratio, that's the fee inside of the fund. So that if it's saying that you're going to get 4.5%, but the net expense ratio is 0.25, you can subtract one from the other to find out, well, here's what I'm really going to be taking home at the end of the day. Okay, so pay attention to fund fees. Some money market accounts are really low fund fees and some are higher. So you just have to watch out for that and pay attention to the money markets that are kind of the default money market funds for whatever institution you are at. Whether it's a Vanguard or a Fidelity or a Merrill Lynch, a lot of them have their own default money market funds because they make money for your cash just sitting in those accounts. So look at those mutual funds, see what the funds are and how much interest you're paying. Again, those are going to be inside of brokerage accounts. And then lastly here, CDs, certificates of deposit. CDs have been around for a long time. Like many of the options we're looking at on this page here, none of these have been that useful to us over the course of the last 15 years or so. So one of the positive things that we're finding from all of these high interest rates is that, hey, we actually can put our cash somewhere and earn a little bit of interest on it. For the last, about 15 years or so, we have to tell folks, hey, I need this cash in 12 months. I don't want it to just sit here. What do I do with it? It's like, there's not really options for it. I mean, you just kind of had to leave it where it was if you really wanted to have no risk associated with it and you just weren't going to make any money on it. So now these short-term savings needs that we have some good options. So certificates of deposit, things to look out for. One of the pros is that you get locked into a certain rate. So if you sign up for a 3-month CD or a 1-year CD, the bank that you buy it from, they're going to say, hey, you're locked in, you're guaranteed that rate for that period of time. A couple of things to pay attention to with that is that if you need to take your money out before the end of, let's say, the 6 months on a 6-month CD, the banks are going to charge you surrender charges. They're going to take, they're going to charge you money to take it out early. And a lot of times those surrender charges could be more than the interest that you were even going to earn in the first place from leaving it there the whole time. So it's really important to pay attention to that. And in that same breath, a lot of CDs at a lot of banks will automatically renew. if you buy a 3-month CD and you don't reach out to the bank at the end of those 3 months to tell them, hey, don't automatically renew this CD, I need it for something, it's just going to automatically renew. And once it's in that auto renew and it's 3 months later and it goes into the next 3 months, it's in there. And you can call the bank and you can yell at them on the phone and it's still going to be in there. I've had to have too many conversations with clients about this. It can be a real pain in the butt. So I'm not saying that CDs are a bad thing. I'm just pointing out that these are things that are important to pay attention to, because sometimes we get, distracted by the shiny object. Oh my God, 5% for 6 months. But then there's these other things that come into play when we don't take the time to do proper planning to make sure, hey, I really don't need this money for the next 6 months. I'm setting myself a reminder to make sure that it doesn't auto renew, 15 days before the 6 months is up, and different things like that. Okay. So these are things to pay attention to. The last point that I want to touch on here, longer period, higher rate, sometimes. Something that many of us have heard in the news over the course of really the last year or so now is this whole inverted yield curve. And I know most folks that we speak with, what's this inverted yield curve? All I keep hearing is that it has something to do with, a recession, and it's, not necessarily a good thing. So what we have going on right now is the shorter period rates for something like a CD or a bond are actually paying us higher interest than what some of the longer period rates are paying us. And so normally on the spectrum of, time to return, right? The longer the CD, the higher the interest rate, right? The longer that you're willing to tie up your money with the bank, the more interest that they're willing to pay you. Same thing with bonds. But right now we have that flip-flopped. And that's what you're hearing on the news about the inverted yield curve, is that right now, the 1-year rate on the CD or the bond might actually be paying a higher rate than the 2-year rate, because of a lot of different reasons. But in a simple form, we can say the banks and the companies issuing bonds and CDs and things like that, they don't necessarily know where rates are going to be in 2 years. So they're only comfortable giving you these high rates right now for so long because they're not sure if they're going to be able to sustain them for a long time. So we have this inverted yield curve here. So with CDs, what we want to pay attention to with that, since these are investments that we get locked into if you go ahead with it, is that don't just automatically assume the longer you go out, the better it's going to be. You might be able to get a better or very, very close to the same rate on a 1-year CD as you could on a 2-year CD, or a 6-month as you can on a 12-month. Okay. And so sometimes it's not worth the 0.1% or 0.2% for an extra 6 months or extra year. Okay. So all things to pay attention to. Now, I went through all of this pretty quickly. We're about halfway through right now, and I just want to hit pause to see if we have any questions that we can answer here before we kind of move forward.
All right, I do have a bunch of questions that came in, so you might have to take a while to answer these.
Okay.
And if we can't answer all of the ones, you might want to hold some to the end. So
Sure.
just let me know.
Yep.
Talk about CD ladders. Is that recommended? What is that strategy?
Yeah, so what CD ladders are, or bond ladders, is the very similar concepts, is the idea of saying, based on the timeline that you need to use funds, you are saying, I'm going to put a certain amount in a 1 month, certain amount in a 3 month, certain amount in a 6 month, so that as you need the money, the funds are becoming due. But for the money that you don't need as near term, you could hold it for a longer period and get a slightly higher rate. That's what a CD or a bond ladder is. Whether it is appropriate for you or not is a completely individual to individual basis. And you may end up hearing me say that a few times today, but for me to say, is it a good idea or not? I'm a very holistic, comprehensive approach to financial planning. And it can be, or it could also be a really bad idea and cause you a whole bunch of, pain in the butt trouble that you don't need. And so That's the kind of thing that if you're going to do that, you really want to speak to a professional and find out, is this actually appropriate for my specific situation, or what would be the alternative to doing something similar?
Thank you. Let's go ahead and move on to this question. How safe are money market funds? Are they also covered?
That is a great question. And so actually we're still on the same page here. So there's two types of money market funds, right? We have money market savings accounts, that is a money market at a bank. Okay, and that's going to fall under the FDIC coverage rules. All right, so if it's in an individual account, up to $250,000. Okay, so money market is their way of saying that it's going to earn a slightly higher rate of interest because of the underlying investments that the bank does to be able to give you that higher rate. Money market mutual funds, the one we have in the middle of the screen here, this is going to be covered under SIPC coverage. Okay, and so you just want to pay attention to the institutions where you're holding these funds and understand the limitations to it. That if you are an individual, and regardless of which option you have here, but if you're an individual and you have $400,000 in a money market account in one account at one bank, you're going to be over your limit of what's covered, and you want to go ahead and look at other options for spreading that money out a little bit.
All right, let's talk a little bit about just a kind of a point of clarification. Is the SIPC coverage still 500K max if it's for a joint brokerage account?
Great question. Yes, it is.
All right, and are ETFs covered as stocks? So I'm assuming this is a
mutual funds, stocks, ETFs are all going to fall under the category of equities, right? Or investment, I mean, mutual funds, I guess not. ETFs and stocks, yes, will both fall under the category of equities and are covered in that bucket of SIPC coverage. But keep in mind, it's not based on the fluctuation in value of your stocks or ETFs. So like right now, the banking ETF is down, right? So just the investment ETF being down, that's not covered under SIPC. It's if the institution who is holding your money, who is holding that investment, right? If they run into financial trouble, where if you wanted to sell your investment inside of your account and take your money out, and the institution itself is like, we don't have the money to let you do it, that's what the SIPC coverage is for, not the fluctuation in value of the investment.
All right. This is a good question. Can a bank call in a CD before its maturity?
Can they call it in? You mean like, can you cash it in before its maturity?
I'm not sure 100%.
I think that's what's being asked, and it's just a difference of terminology. And so they can, right? You can call the bank and say, hey, I need my money, but just keep in mind, most likely they're going to charge you what's called a surrender charge, noted here at the bottom of the screen, meaning they're going to have a fee associated with you taking the money out of the CD early than the designated period.
All right. A couple of these I kind of want to hold to the end because I feel like you're going to cover them. So let's keep going. If you put questions in the chat and we are not getting to them, it's because I know Rob's got some good stuff to cover first, and hopefully at the end we can circle back on these.
And I think we're doing pretty good on time, that I'll stick around as long as we need to answer questions. So
excellent. Sounds good.
Okay. All right, so let's shift to maybe what might be on some folks' minds, which is to say, all right, I don't necessarily need the money in the next, 18 to 24 months or less. I've already kind of checked the boxes to say, the money that I do need in that period is set to the side. I'm doing some home improvement and that money's already set to the side, whatever it might be. And I still got this chunk of cash, and I'm really not sure what to do with it. So, but I know it needs to get invested and do something, but I'm just nervous about the stock market because, right, that's fair. A lot of folks are nervous about the stock market. There's a lot of interesting things going on in the world right now. And there's just so much information out there. I don't know who to believe. I don't know who to trust. We hear from our coworkers and our spouses and our friends and our family and Uncle Jim. And, it's tough to know who do we actually need to listen to for guidance. So when we don't know, with things like the stock market or real estate as well, things that we have a pretty wide breadth of history of data to go off of, sometimes history can be a helpful guide, right? This is not to say, past performance is indicative of future results, right? We all know that, we hear it all the time, but this is just to be as a helpful guide of, can what has happened in the past during times similar to what we are in today be helpful towards giving us some information about what might be likely to happen here in the not too distant future, okay? So the following information that I'm about to show you goes back to 1926, start of the S&P 500. We are just shy of 100 years worth of data right at the moment. That's pretty good data, especially with the technology that we have developed over the last 20 years or so. The information is from BlackRock. This is what they call their student of the market presentation. This is all up to date as well. Okay, so a few slides here for you to say what has happened in the future, what might be likely to happen. So stocks for a calendar year lost money for just the 26th time over the course of the last 97 years. So let's just call it about 25% of the time stocks have finished negative. Now you can see here, most of these numbers aren't significantly negative, but negative nonetheless. And last year was actually the 7th worst finish that we've ever had. That being said, if we look at the return in the following 12 months after one of these down years, of all 26 of these times, the following 12 months have averaged a 13.2% returns for stocks. Now, that's not to say that we're guaranteed to do 13.2% in the upcoming year here, but 26 years going back to 1926, say on average, we did 13%. That's better than the 100-year average of the S&P 500, around 10%. Looking at what we're going through today and what has happened in the past. And so what has happened with US stocks and bonds in the 12 months following the last Fed rate hike? So we're not quite there yet, right? The last example, we're just past that finish of the previous year. We're not probably quite to our last Fed rate hike, but we're probably getting towards that end. And in the 12 months following that, stocks averaged 19.9%. US bonds averaged 11.5%. In our next example here, periods following peak inflation. So going back to 1926, we've been here before, right? And this is something that I talk about with clients all the time, is that it might feel right now like we're in this very unique point in time. And there certainly are things that make it unique, but when we zoom out and look at the big picture, we've been where we are right now before. World wars going on, supply chain issues, high inflation, rising interest rates, rising oil prices, fluctuations in employment. We've been here before. We just have nuances that make it different today than other times in the past. So when we zoom out and we look back at history as what has stocks and bonds done following the 12 months of peak inflation, all the data that we have here tells us we hit peak inflation last June. Right, so peak inflation, that's what the data and the numbers say, for what it's worth. In the next 12 months following peak inflation, stocks averaged 18% and bonds have averaged 7.1%. So these last 3 examples, this is one going to back last June, looking 12 months forward, one looking 12 months forward from a period that we haven't quite reached yet, and then one looking 12 months forward from a period that we just recently passed. So 3 different examples here. So let's take a step back and let's say all right, well, let's say if these numbers were more like in the 12 to 24 months following these periods, right? We don't know, the stock market doesn't care about our calendar year, right? We wish that maybe it did, but it doesn't, okay? And so let's just think about, 12 to 24 months following these periods. looking at these returns and trying to decide and be uncertain about the stock market, this is starting to give us somewhat of a pretty good indication of what the stock market may do in, let's just say, the next 12 to 24 months. Returns are well above average for bonds and pretty significantly above average for stocks. And I think most of us would say, especially if we talk retirement planning at all, where we're using a baseline return of 5 or 6% just as a well, if I can withdraw 4% and I'm getting 5 or 6, these are well above those numbers. And so the idea here is to say, we're not sure what to do with the stock market. So what does this really mean to us? Well, maybe it's not so scary after all. And if we really think about it, typically throughout history, the best times to do investments of any kind is when there's a lot of fear about the investments, right? But they're proven long-term investments. I'm not talking about the newest and latest, greatest thing that, crypto meme stock or whatever. I mean, long-term, large, healthy companies proven over the last 100 years of data what they've done, things like stocks and real estate. We have a decent idea of what might be likely to happen here in the coming years. And so, if everything's really scary, it might not be such a bad time to put some money to work, right? There's an old saying that goes, if you get into your cab in New York City and your cabbie is telling you about the investment, it's probably a little bit too late, right? And so that's really, even though it feels like a good time, it's probably not actually a good time because everything's already way at a high. And so, in addition to that, when we're talking about long-term money, long-term investments, moral of the story here, don't make decisions based on the news today, because in the short term, this stuff's going to go up and down like that, and we already know it. But in the long term, we have a pretty good idea of what we think might be likely to happen. Okay, so real quickly to wrap up here, a couple things to help guide your decisions. One, use history as a guide. We just talked about that. Number two, use timeline, right? I just have a kind of a simple saying here for folks. So if you aren't sure how risky you want to be, the shorter the time until you want or need the funds, the less risk you should take, right? You got a really short time until you need your money. You got to take less risk because we don't know what's going to happen with some of this stuff. The longer the time until you use the money, the more risk you might consider. Okay, I say might consider because taking more risk is all associated to, again, your individual preferences and how, are we talking 3 years? Are we talking 20 years? What you're comfortable with, what type of investments you're talking about. But this is just a general rule of thumb, okay? Fortunately, again, like I said, we've got an opportunity here, for short-term money where we can actually earn some interest on it. And the last thing here is to help yourselves create future flexibility when you're trying to decide about how to allocate funds. Utilize different buckets of money for different purposes and use different types of buckets. So you could have different savings accounts for different reasons, but then also think about using pre-tax buckets and after-tax buckets or real estate buckets or tax-free buckets, right? And so use bucketing to help spread out your money. This right here is another way to do diversification across your financial picture. That's everything that I've got here for us today. So if you're still not sure what to do, please speak to your financial planner, speak to a financial professional. That's the best way to go. If you don't have one, Advice Tracer has some great resources for helping you find an advisor near you. That's all that I've got. So if we've got more questions, it looks like we've got maybe 10 or 15 minutes or so.
Yeah, let's go ahead and address some questions here. So one question that we had is, what about credit unions? How does that work as far as the FDIC? Does the FDIC cover credit unions?
Yeah, so that is a excellent question. And so the FDIC and SIPC do not technically cover credit unions. Credit unions are under their own coverage. It's the NCUA. Is the same type of coverage that credit unions have, and then they have a very similar set of the ownership type rules.
Okay, all right. So they are insured, but not under the same entity.
That's correct.
Okay, great. All right, here's another question. Let me get my list here. Can you talk about I bonds?
Sure. So, I can talk a little bit about I bonds here. So, I bonds are, I stands for inflation. So they are inflation bonds. Back last summer, when inflation peaked at 9%, this was, all the rave, if you will. I would say it might be one of the safest investments in the last 2 years that became like a popular thing, versus cryptocurrencies or meme stocks and things like that. And so I bonds will fluctuate with inflation. And so they're what's considered an inflation protected bond. And so if you buy in and inflation is at 4% and inflation goes up to 9, every 6 months or so, the interest on the I bonds is going to reset. And for that period of time, you will earn a higher rate of interest. So, but just like the interest is earned higher as inflation goes up, then the interest is also earned lower as inflation goes down. You can only put up to $10,000, per person per year in the I bond. So they can be a good thing for a little bit of money. You can't spread them out to, kids and grandkids and stuff like that. But again, this is the kind of thing that it is individual to individual. And then also to capitalize on all of the interest to be earned on the I bond, it has to stay in there for at least 5 years. No penalties for taking it out early. You just don't get all of the interest that you might have supposed to get.
All right, thank you. This is a good question. Should I split up IRAs with different brokerages if the one I have exceeds 500K? Is it wise to juggle multiple IRAs with different brokers?
I would say it's tough for me to say yes or no to that. Obviously, a lot of folks have IRAs with significantly more wealth inside of them than just $500,000. I tend to lean on, if we are worried about our institutions like Fidelity or Vanguard and places like that are the ones holding these large investment accounts that we have, then those institutions start to get in trouble. We're really in trouble, and so I think that it's going to cause more hassle than what it's worth on your IRAs. And especially if the majority of that money is invested in your, spread out across a large portfolio of investments, I would lean towards, sticking in one place with your advisor where the account can be managed appropriately, versus spreading out every 500. But that would just be a personal preference. Again, it's different for everybody. And if you have more stress about where these institutions are at, then you might spread it out a little bit more.
All right, another question, and maybe a little bit of terminology here. What about treasury bills? Should I buy those?
So treasury bills are going to be a lot of what's underlying in our money market funds and mutual funds. And so you may have treasury bills already inside of some of your accounts without even knowing that you have, treasury bills in some of your short-term bond funds or money market funds and such. Now, there is more information out now about literally going to treasurydirect.com and buying T-bills. I think you really have to be in tune with what T-bills are and how they operate to be going out and buying those on your own. Otherwise, I would defer to going towards a fund that maybe invests in T-bills or having an advisor help you make those decisions versus you buying individual T-bills on your own.
All right, this is another good question, and I'm going to reword it a little bit. So to the person who wrote this in there, I hope this covers it. So let's say you're at a brokerage in the same brokerage firm, and it's one person and they have different types of accounts, like they have a Roth IRA and an individual IRA and maybe a trust account.
Mm-hmm.
Does each of these have its own SIPC coverage?
Yeah, so the SIPC ownership types fall under the same ownership. If I go to, am I still screen sharing? Okay, there we go. All right, so just going back to this slide here, these different ownership types, again, these are just examples. This is not all ownership types. These are examples, right? These same ownership types, they apply to SIPC coverage as well.
All right, we're getting some more questions in. That's great, folks. Get those in while we have the time. Can you talk us through how to compare an actual rate of return on a money market firm at a brokerage versus a money market account at a bank? So one that uses an SEC rate versus an APY, are they really the same?
Yeah, that's an interesting question. And so there are things that you want to pay attention to as far as what some folks refer to as yield. And so, you know, a big thing in that is fees. Okay, so you definitely want to factor in your fees for whether it's at the bank or it's in a money market mutual fund. Something that you can, I mean, the APY on the bank accounts, that is the annual percentage. So just something to keep in mind with that. When you see that, it's not like, you know, if it's 4%, let's say, you're not getting 4% a month on your $100,000. You're not getting 4,000 a month. You get 4,000 for the year. So just keep that in mind. It is really APY. That same concept applies to CDs while we're on this topic. Okay, so if it says a 4% CD and you do it for 6 months, well, 4% is the annualized rate, right? And so just keep that in mind. All right. And so, and then on the funds that are a money market mutual fund, something that you can look at is the SEC yield. So the recent 30-day or 7-day SEC yield would tell you what the most recent yield is on that account. And then you want to go look at the net expense ratios. And so you want to see how much of an expense, is it 0.1, is it 0.3, you know, to go against the 3.5 of the yield, right? And so that's how you can kind of pay attention to what that would be. And again, just know that is an annual period. So if you have 4% and you only have it for 6 months, you know, $100,000, right? You can do the math there. Hopefully that helps with some clarity.
So now that you mentioned CDs, I did have a question about CDs. So
Okay.
when you buy a CD, if the CD rates drop, does that affect the CD that you're currently in? And can you talk about that?
Yeah, that's a great question. So one of the benefits of CDs, especially like with what we have going on in the world right now, is that whatever you buy the CD for at that term, right, you're going to be locked in for that term. If it's 6 months, then that CD rate is going to stay the same for 6 months or 1 year, right? And so, you know, there's this give take when we're doing planning to say, well, what do we think is going to happen with interest rates? If we think that we're kind of getting close to a peak and that, you know, a year from now, they might be lower than what they are today. And I'm not saying, I don't know, I'm just giving an example. Then you might say, well, I'll take what I can get today at 5% and lock it in for a year, knowing that no matter what interest rates do, I'm going to get my 5% for the next year inside of this CD. And then I'll have to cross that bridge. If I missed out because they kept going up, well, then I missed out. But if they went down at the end of this, you know, year, then I did good. And I got my locked in rate for, you know, for the 12 months. So you will be locked into whatever rate they give you for that period.
So whatever is newly offered doesn't apply to what you already have.
That's correct. Once you get that CD, it's a contract, and that's why they can charge you money if you want to take it out early.
All right. So can you talk about what a callable CD is, and can the bank cancel a CD before its maturity?
So technically there are investments that are what are called callable, where the bank can say, hey, we're going to give you this rate, but if we decide to call it back, then they have that option. Okay. And that's getting into the fine details and stuff that you want to look out for. And that's a good question to ask before you go about doing a CD, especially if you're putting any real significant amount of money into it. You know, if you're talking a few $100,000, $1 million into a CD, you really want to get those fine details locked down.
All right. These are a couple more random questions I have that don't really fit into the flow of things, but are 529 savings accounts subject to the SIPC rule?
Are 529 savings accounts subject to the SIPC rule? You
I'm
know,
assuming like the SIPC,
yeah. So, I suppose that is going to depend where the 529 account is held. Okay. I would imagine if you did one of the American Funds, SIPC 529 plan, that American Funds is an institution, right? They're a brokerage institution that is enrolled in SIPC coverage. If you are saying that maybe you do the 529 plan directly with the state, you're in Alabama and you do the Alabama 529 plan, then you would, I don't know off the top of my head, you'd want to check. I would think, but I cannot say for certain. I believe that it would depend which institution you are holding that 529 plan at.
yeah, that would make sense. And also, it's individual to each person. So you're going to have to check with your financial advisor, whoever is administering that, they can let you know. All right. Is there a danger in keeping too much cash on hand? Can you talk about holding cash for a long term and what the danger is in that?
Yeah, that there is a real danger to that, right? We think that just holding cash is safe, but cash doesn't, in the grand scheme of things, doesn't make us money, right? Interest rates are up where they are right now. We know they won't stay there forever, right? It could be longer than what we think, but they won't be there forever. And let's say that you were holding a whole bunch, you had $1 million in cash back in, 2016, 17, and you've just been sitting in cash. Well, you've missed out on incredible returns, even inside of very conservative portfolios in the stock market. Even with the pullback that we've had right now, if you were invested just from 2016 or 17 on, you're still pretty significantly up. And not only that, but then if we get back to the last year or so, you've lost your real return on your cash in the bank, has lost money fairly significantly to inflation, right? The cost of goods and services have gone way up. And one of the biggest powers that we get from investing in things like stocks and real estate and bonds is the ability to keep up with inflation, right? We've been somewhat spoiled the last 15, 20 years or so. We've been at zero inflation. And that's not the reality. Reality, the last 100 years of inflation is around 3%. And so if you're not growing your money at, let's just say, at least 3%, your real return, when you look back, it is negative, right? So it might feel good in here in your heart, right? Because you're not having to deal with the fluctuation and it's there. But if it's there for too long, it definitely is a bad thing. And that's why it's so important to do planning, to say, here's my emergency fund. Here's what I need for expenses in the next 18 to 24 months. And then, 24 to 36 months, kind of gray area, depending on, your situation. But then really get outside of 3 years. It's like, if you don't need the cash for 3 years, it's time to start thinking about options for putting it to work, right? Even if it was just all in bonds or whatever. But I would really encourage folks to look into opportunities to put your cash to work for you. Let your money work for you. That's one of the keys to building wealth, is let your money make money for you.
All right. We had a question about annuities. Can you talk just a little bit about them in general, what they are? And obviously it's going to be an individual decision for each person.
So, I thought about mentioning the annuities here today. I didn't want to get into it. So all I'll really say on that for right now is there's a really big world of annuities out there. All right. It's much different than what it was 20 or 30 years ago, or even 5 years ago. It's a really big world. And with regards to the conversation we're having today, number one really important thing, an annuity is not a short-term investment in almost any way, shape, or form. And so do not expect to put your money into an annuity, get some guaranteed rate that they're telling you, and then in 2 years be able to take your money out, okay, without being penalized pretty severely. Okay, so do not, I would say that's the biggest recommendation that I can make about annuities right now today, is that they can be great tools to utilize in your plan, but they are not short-term investments, right? They are absolute bare minimum 5-year plus. And that's then being specific to look at annuities that only have 5-year surrender periods and such. So Annuities, I'm not an extremist about tools out there. There's some folks that oh, annuities are the best thing, or annuities are all the worst thing, or only stocks, or only, that's not how I operate. I believe that they are all tools available to us. Some tools get used more frequently than others, but we can find uses for certain specific purposes for all of the tools. And so annuities, they can be a great thing, but if they are poorly implemented from poor planning, they can be a bad thing, and they're definitely not short-term. They are long-term investments.
All right. And then last question to round this out, speaking about using your cash wisely, can you talk about gifting to, say, your children, adult children's spouse, other individuals, and having that tax-free as far as gift tax goes?
Yeah, so and you know, this is almost another presentation here, really, to be honest. But if you are in a situation from an estate planning perspective that you've got, first of all, make sure that you are taken care of. Okay, I have a lot of clients that are very charitably inclined and they want to give money, but it's like, hey, we gotta make sure you're good first. So make sure you've checked your boxes and that your projection is way up, and you know, you're not, you know, then okay, we want to give money away. If that's appropriate in your situation, gifting money away, you know, cash, whatever the annual limit is at that point in time is, you know, it's not a bad thing. Certainly is something that can be done with cash, especially if the family members you're wanting to give to are, you know, can make more use for it now than waiting till somebody passes away. That can be a great thing. But that really is a separate presentation altogether to talk about some of these estate planning topics in relation to everything right now.
Well, I would just encourage that person, if they're interested, they're welcome to leave their contact information, and we're happy to reach out to them.
Yeah. I mean, that's the kind of thing that is individual. And one thing I will say on that is keep in mind that when you're gifting money away, it's not that it's necessary. If it's just cash, it's not that it's necessarily taxable if you give too much. It's that you're keeping it under the annual gift tax limit, meaning the amount that if you go over, you would then have to file it against your lifetime gift tax exemption. And so just some folks get confused there. I'm sure that probably prompts a whole bunch of other questions, but I think we might be out of time for digging too far into that today.
All right. Well, folks, thank you so much for being here. We really want to thank you for your time and energy. Look for an email with a link to the replay of this event, and you're welcome to share that replay with your friends and family. We want to thank Rob and the organizations that have made this webinar possible today. Thank you so much. And we do appreciate any comments in the chat. If you want to give Rob a thank you, we'd really appreciate it. Here at Advice Chaser, we are all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has agreed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, for Advice Chaser, thank you so much, and we will see you at another webinar soon. Goodbye, everyone.
Thank you all.